Hey, how's it going, everyone? Welcome to Finance with Avrin. If you want financial freedom, you don't need dozens of accounts. You just need the right ones. In this video, I'm going to walk you through 5 financial accounts that build wealth, protect your money, and set you up for long-term success. And stick around until the end because I have a bonus account for you. So actually 6 accounts in this video. And that 6th one is kind of like a hidden cheat code that you may be eligible for. And some of these accounts you may already have. Number 1 for sure, maybe even number 2 and number 3, but definitely having at least 4 out of 5 of these could set you up for long-term financial success and a great retirement, and even possibly financial independence, retire early. Yes, the FIRE movement. So let's get right into it here, starting first with the checking account. Of course, this is the account you probably already have. You're familiar with it, but not all accounts are alike. And that goes with all of the accounts on this video. There's definitely better versions of each account out there. Let's get into it here first with the checking account. Now, what is this? This is a bank account designed for daily transactions, receiving paychecks, transferring money, paying bills, and using a debit card. So think of this as the central hub for your money. Like, if you got the little brain stems, you got your brain and you're thinking about different things or whatever. If you're a financial portfolio, this checking account is like the center of it. This is where things are moving throughout. You zoom in into your financial portfolio. This is the hub of it right here. Why does this account matter? This is a foundation of your financial ecosystem. Money flows through here before being allocated elsewhere. This is a good way to have this account work for you in motion to set up automatic transfers to the other accounts we're going to get into in this video. Now, with your employer, you can set up a certain amount of money or percentage of your money from your paycheck with a lot of employers out there to automatically go to the other accounts. You can do that as well if you want to. If that works better for you, that may work better for you. Now, for some people, they want to get all their money in one spot at first, run their paycheck all in one spot, see it, and then divvy it out. For a lot of people, checking account is going to be the main hub. So you want to make sure you have a strong, solid checking account. Examples of some great checking accounts out there are the Capital One 360 checking account, SoFi checking, Ally checking, Fidelity cash management account, Chase Total checking, First Horizon, First View checking, Wells Fargo everyday checking, and credit union checking accounts out there. Now, for some of these accounts, they have a monthly maintenance fee, like the Chase Total checking and the Wells Fargo everyday checking. But there are ways to get around that to be able to have that waived. Now, a lot of the online banks like the Capital One, SoFi, and Ally checking account, there's no monthly maintenance fee. So there's definitely pros and cons with the different checking accounts out there and things you need to look out for sure. Now, I have a video about the top 5 checking accounts available with must-have features. You see it right there on the screen, the thumbnail and everything. I'll have a link to that down in the description. And also I have an in-depth detailed review video of the Fidelity cash management account, which could be a great account for you as well. So definitely want to have a nice checking account that has features that work for you, like mobile check deposit. Maybe you deposit a lot of checks. You don't want to go anywhere physically to deposit that check. Make sure you have mobile check deposit. With the transfers, you want to look at the limits and different things like that. If you transfer a lot of money, you don't want to be held up with your checking account with, getting hit with monthly maintenance fees or having features or transfer issues that you won't be able to use this account to its full potential and have that ease of use with it as well. Now, those are just some examples of some great checking accounts out there. I've used pretty much actually almost all of those accounts at some point. I haven't used a credit union checking account. Just me personally, I just haven't used credit unions often in my life, but some people out there do that and they like those. So that could be a great account for you. But a lot of those accounts right there I've used and they work very well, nice user interface and so forth. However, you may already have a checking account that works great for you. So check that off of the list. You got the checking account, that's great. Now, key benefits of the checking account, easy access to funds. This is going to be the account you have your transfers, maybe your ATM transactions, debit card transactions, cashback transactions, online bill pay. Some banks have notary services and different things like that. So you want to see what's important to you with your checking account, what the features are that you need, and they could be key benefits if you have the right account. Now, pro tip with this account is actually not using it for daily transactions. You can have a reward credit card. The credit cards out there that pay, 2% cash back, 3% cash back, maybe a bonus if you're eating at that restaurant, a bonus if you're shopping there, and so forth. There's various accounts like that. I'm going to start doing actually more videos on reward credit cards because I use them personally. I have a lot of experience with them. The key with that, of course, is that you definitely want to make sure you pay off that bill each month. You don't want to fall down that trap, that rabbit hole of like, oh, I got a credit card. I'll just swipe, and then, oh, I can't pay the full bill each month. Then you get hit with the APR and they're typically around 20-something%. And that's interest that you don't want. That's the bad interest. We're going to get to some good interest here in the next account, but no, that's the bad interest. So a pro tip, use a credit card that pays rewards, as your daily transactions. and maybe even bill pay. Some companies out there, utility companies, will let you pay the bill with your credit card. Now, some of them may charge a fee, 2%, 3%. So you want to look out for that as well, but some don't. So you might want to look into that and then just pay off that credit card with your checking account. So a little tip there. Some of you may already be doing that. Some of you may be, oh, you know what? I didn't think about that. There you have it. Let's move on to the next account here. It's going to be the high yield savings account. It's an interest earning account with a higher APY, annual percentage yield, than traditional banks. This is not a traditional savings account that's paying a measly 0.1, 0.2, 0.5% APY. That's like the national average for a savings account out there is under 1%. High yield savings account are going to have a higher APY and pay more interest than those traditional bank savings accounts. Now, why does this account matter? It protects cash while earning interest. This is great for shielding emergency funds, savings goals, and any savings from inflation and keeping cash available. Now, inflation sometimes has been higher than the high yield savings accounts APYs and the rates. Now, however, you see it right there on the chart, it's going down. However, it fluctuates just like APYs of savings accounts fluctuates. And there are times where you can beat inflation even with just a high yield savings account. Now, of course, there are other ways to beat inflation. We're actually going to get into those accounts later that you can earn more potentially than a high yield savings account. But a high yield savings account is very important for having that emergency fund, other kind of savings. Maybe you want to put it all in one high yield savings account and just, have a different, allotments to, emergency fund. Maybe this amount is for a vacation. This is amount for a car, so forth. There are savings accounts out there that have buckets, vaults. They call them different things where you can actually put the money in certain sections, kind of organize your money in the high yield savings account. And let's get to those examples. Ally, SoFi, Capital One, Apple, Markets by Goldman Sachs, Newtek, Wealthfront. Now, Wealthfront's account is kind of like a hybrid checking/savings account. All of these accounts have nice APYs, annual percentage yields, where you can earn a nice amount of interest, over 3% for all of these. Now, they have been higher. However, the trajectory of APYs have been going downward. If you've been locked in here with me on the channel Finance with Avrin, you know where these yields have been and where they're at and where they're going. So I make videos every other month of the top 10 savings accounts ranked by APY. I'll leave a link to it down in the description. And I also do various reviews and overviews of savings accounts and other type of accounts on the channel. And these accounts, I've actually used several of these accounts that I have on here as examples. These aren't the only high yield savings accounts out there. There are a lot out there, but like the checking account, you want to look into it and see what features that you want are available on that certain savings account. Now, for a savings account, personally, I don't do a lot of transactions on it. So I just want to make sure I have a high yield and it's FDIC insured, Federal Deposit Insurance Corporation, very important. So that money is typically protected up to $250,000. Some of the companies have higher FDIC insurance than that, where they spread around your money, basically deposits to other banks to have higher FDIC insurance. So when you see that higher than that typical $250,000, that's basically typically how companies do that. They kind of spread around your deposits to other banks to have that higher FDIC insurance. That doesn't mean you have an account with all those other banks that they're partners with. That's just how they give you more FDIC insurance. So high yield savings account, very important to have money sitting there and working for you. Key benefits of a high yield savings account: balance safety, liquidity, and growth. This all works together for you while you're sleeping, while you're at work, while you're eating. Your money is working for you, earning interest, and it's safe because it has that protection, either FDIC insured, or if it's in the credit union, you want to make sure it's NCUA insured, and it's sitting there and it's actually available for you. So it's not like an account that's locked out that you can't get into, that's going to charge you a fee if you withdraw from it, or a penalty or anything like that. High yield savings account, you can transfer that money out today, tomorrow, next week. You need $100, you need $1,000. Maybe you got that down payment now saved up. You want to move that over for the house, for the car, or whatever it is. Transfer it to your checking account. Boom, there it is right there, liquid. So it's available for you. That's definitely a benefit with the high yield savings account. So you're earning high APY and you're not doing that at a disadvantage, at a cost to you. You actually have availability to that money. Now, pro tip with the high yield savings account, very important. You want to make sure the account is FDIC or NCUA insured. If it's a bank, FDIC insurance is what you want to look for. Even if it's a fintech company that's not necessarily a bank, but they're kind of underneath another bank, they'll have the FDIC insurance, or they should, through their partner bank or their parent bank, their parent company. So you want to look for that for sure. And another pro tip, maybe you want to keep this account separate from your checking account, maybe a whole different company. So you don't have that temptation to just transfer money over to your checking to pay for that. Oh, that came out or that was released. Oh, I got money in my savings. I could just transfer it over there and pay for that. Now that you could be warranted. You could have a nice emergency fund, very high savings account, and it won't hurt much. You're good. That feels good. It's great. Slide it over. But if you're working on building your high yield savings account, building that emergency fund, you may want to put some blocks kind of in front of you to make it a little bit, more transactions to kind of move it over. That way you're like, I don't feel like transferring that to a whole nother account. Because when you have a savings and checking in the same company, those transfers are quick. I've used a checking and savings account with SoFi, and now they work very well together. And that's a benefit sometimes. Maybe you want that quick transfer. Maybe that will be a good thing for you. Maybe it won't be a good thing for you, because when you typically have a checking and savings in the same company, you transfer that money over, it's there right there immediately. Like in a few seconds, in a few minutes, that money's over to the checking and vice versa. So that could be a benefit for you, or it could not be, just depending on things. So that may be a pro tip for you, maybe not. Definitely high yield savings account, a great vehicle and financial tool for your money. Earn that high APY. Keep that money secure and add to it, build up to it. Typically, for emergency fund, you want 3 to 6 months worth of expenses. In some economies, you may want 6 to 9 months or 9 to 12 months. If it's kind of shaky out there, you're unsure about your job, things like that, you may want to have a bigger emergency fund. So depending on situations, yourself better than I know you. I know some things about you probably, you're locked in on this channel. So that means financial education is important to you, and that's great. So that's awesome. But your specific financial situation, your career, things like that, not sure. You know better of how much you probably need to have in your emergency fund and so forth. Now, let's get on to the next account. That's going to be the 401k or employee sponsored plan with match. Now, what is this? A retirement plan offered through employers. Typically, contributions are pre-tax, meaning they haven't been taxed yet. They get taken out of your earnings, haven't been taxed yet. They'll get taxed later. Now, that could be different depending on the employer-sponsored plan situation. Maybe you have an option to go the pre-tax or the non-pre-tax route. That just depends. Typically, most of them, from where I've worked through various companies, they are pre-tax. Now, many employers match contributions up to a certain percent, and this is a key with this account. Now, why does this account matter? The employee match is essentially free money. You got to take this match. If this is offered to you and you don't have this account, then look into it. This is not financial advice on this channel. This is financial education, but this is like essential. And those contributions typically come from earnings automatically. So that's money you're not even really seeing. You set it up, you're not really missing it. You learn how to work with the money that you're making from the employer, for your bills and for your savings and other investments and so forth. That money that automatically goes to that 401k or other employee sponsored plan, it's just automatically put in there. You don't see it unless you, of course, log into that account and look into it, and you see the contributions, or you look at your pay stub and you see, oh, okay, that was taken out. There's the match. That's nice. Okay. Typically, it's transferred over there. It's going to put to work for you. Now, of course, you want to log into that account and see what you're investing in that account with the mutual funds or ETFs and so forth. You want to make sure, you're invested in high quality funds with low expense ratios. Now, examples of these plans and these accounts, they're offered by various big major financial institutions out there: Vanguard, Fidelity, Empower, Charles Schwab. You may already have an account like this, and of course, what the company it belongs to. And typically, of course, you can't really choose that. Whatever the employer uses, the company they use is Vanguard, Fidelity, or so forth, Empower. That's what you got to use. So even if you got something against the company or something, just put that aside and contribute to that money and get that match. I know some people have like certain, I really don't want to, bank or have my money in this bank or so forth. With the employers, they typically work with one. Maybe they work with another. You can do that, choose that one, but typically it's one. Put those contributions in, get that match, move forward. Yours may not be a 401k, depending on where you work, maybe a different type of plan, 403b, 401a. That doesn't change the fact that it's an account for financial freedom and financial success if used properly. Key benefits for these accounts: immediate ROI, return on investment on those matched dollars. No matter what the market is doing, you're getting that match contribution. So if they're matching, 100% up to 4% of what you're putting in, or up to 2%, and then 50% up to 4%, whatever it is that they're matching, that's free money. That's match dollars. That's immediate return on investments. You're just putting in your contribution no matter what the market's doing, and you're getting a match contribution to what you put in. And also, other key benefits: automatic saving and investing. Like I mentioned in the Why It Matters section, this is automatically happening behind the scenes for you. Typically with a lot of employee sponsored plans, it's going on when you get paid. You don't see that money necessarily in your checking account or your other accounts, because it's going to your retirement account, your employee sponsored plan with that company, and getting put to work automatically. Now, pro tip for these accounts: always try to contribute enough to at least get that full employee match. Definitely look in that employee benefits packet if you don't have anyone to talk to about it, or if you do, talk to somebody about it. If you're unfamiliar with it, look in that employee benefits packet, whatever you need to do to find out when you can enroll in this, and enroll in it as soon as possible. And then find out what the contribution matches are, the limits and this and that, and at least put in that amount to get that full match. Maybe it's 100% up to 2%, 100% up to 4% of what you put in. Maybe it's 100% up to 3% what you put in, and then 50% of up to 5% what you put in. That was a lot of numbers, but whatever it is, put that amount in there, that percentage of your paycheck, if you can, to get that match. Definitely important, because that's going to grow for you with your contribution. Very important. Now let's move on to the next account here. That is going to be the IRA, individual retirement account, Roth or traditional. Now for a traditional IRA, your contributions to it are pre-tax, which is lowering your taxable income now. However, withdrawals are taxed in retirement. So for a traditional IRA, the money you're putting into it, it's not taxed. It could lower your taxable income, put you in a different tax bracket, so forth, depending on, of course, other variables. We won't get into all that with taxes. Could do that. However, when you retire, when you withdraw that money out of the traditional IRA, that's when that money gets taxed and the growth on that money you put in. Now for a Roth IRA, contributions to it are after tax, but withdrawals in retirement are completely tax-free. So the money you put into a Roth IRA is already taxed. It won't lower your taxable income no matter how much you put in there. However, when you withdraw that money out of a Roth IRA, when you retire, that money is completely tax-free. The growth on that money in there, all of that tax-free. So yeah, Roth IRA for me personally is a powerful tool. Maybe better for you, or maybe a traditional IRA may be better for you. Why does this account matter? It expands retirement savings beyond employer accounts and often offers more investment choices with ETFs, index funds, and stocks. With the employer-sponsored plans, that previous account we were talking about, the slide on that and everything, those accounts typically have like a selection of funds you can choose from, maybe 10, 15, 20 or so forth, or they have that target, retirement date, if it's 2040, 2045, 2050, something like that. They maybe have that, some other options. Typically with the employer sponsored plans, no matter where they're at, Fidelity, Empower, so forth, they don't have as much of a selection from you to choose from. A Roth IRA or traditional IRA, you're going to have more choices. With an IRA, you're being opened up to a broad amount of investment choices. You can invest in individual stocks in that account, various ETFs. There's a ton of ETFs out there. And of course, I have videos on stocks, ETFs, and index funds and so forth. So with an IRA, you definitely have a more choice of securities to invest in. So examples of IRAs, some of the companies that offer these: Fidelity, Vanguard, Charles Schwab, Robinhood, Betterment, Wealthfront, SoFi, the list goes on and on. One thing that's definitely important for me with an IRA and individual brokerage accounts is the ability to invest fractional shares. Because, a lot of companies out there are, $100, $200, $300, $400 a share. And sometimes you may not want to put that amount of money in the account and buy just one share of something. You may want to split it up. You may want to say, I want to put some money in, Microsoft, some money in Google Alphabet, some money in Meta, some money in Bank of America, some money in Amazon, some money in NextEra Energy, some money in JP Morgan Chase, some money in, you get the idea. So you want to just spread around the money to different companies or ETFs. You don't want to just buy one share or two share of something. So fractional shares are very important to me, and it may be important to you to look into to purchase. Maybe it's not. Maybe you just want to buy one share at a time of something, or 5 shares, 10 shares at a time of something, and that's totally fine for you. Then that part won't matter. However, fractional shares are sometimes a key for people to invest, because that big stock price, that big ETF price that you see up front can sometimes kind of deter people from investing. They look at a stock and they're like, oh man, I don't have $200 something to buy a share of Amazon. Investing, it's only for the rich. No, you don't want to have that mindset. You want to be able to invest as much as you can when you can. So fractional shares, you got $100 to invest. Put that $100 into Amazon, you got, 0.4 shares or something. Well, you do that again, you almost got 1 share. You do that again, you got 1 point something shares, and so forth. And just like the other accounts, some features may be more important to you. So something to look into if you don't already have an account that you like is to see what's out there and see what the features are. Look at the fees, make sure, you're not going to hit with a lot of fees and so forth. Now, for some of these accounts like Betterment and Wealthfront, they have like a robo advising features going on with them. So if you want a more hands-off approach, you want, basically AI or to happen automatically, robo advising, robot investing in short for, to just happen for you. And that, maybe you'll choose, your retirement day, your, level of risk and so forth. And then it does the rest of the work for you. That may be something more interesting to you. You may want to go that route. That's another feature that may or may not not be important to you. It may help you decide where you want to have that account at. Key benefits for an IRA: tax advantages and long-term compounding, plus more control over investments. We went over what a traditional and Roth IRA is in a different tax situation with those, so that could definitely work in your favor. And then long-term compounding, you set this up, the earlier the better. You got years, you got decades or so forth of compounding, of growth, on top. And the market's been like, the market overall, S&P 500 has been giving out double-digit gains. I mean, it's 20-something%, 16, 18%. Now, the average is like around 8, 9, 10%. It's definitely been going up lately in the past few years. And long-term, traditionally, the market has done very well. So that's that long-term compounding. You want to have your money in that. So investing is definitely a way that you could beat inflation and double beat it, triple beat it, and so forth. Because inflation is not always running hot like it was. You see right there on that chart a few years ago right there. So it cools down and you can beat it even more. And even when it's heated up and it's hot like that, you can still beat it with a nice year or so forth in the market. Now, more control over investments. We went over that, of course. You have the ability to choose those ETFs, those index funds, those stocks. You got more choices. There are a ton of them out there. So yeah, definitely a key benefit. Or it could overwhelm you. Check out my channel. There are definitely other channels out there that have great videos on specific investments, ETFs, index funds, and stocks. Definitely, I do have that here going on at Finance with Avrin. And you can look into it, research if you want to choose individual. Maybe you just want a little more hands-off, but maybe you want some hands-on, but some hands-off. ETFs, exchange traded funds, and index funds. You have a basket, a pool of stocks. You just put the money in that and let the fund manager and so forth, the company, handle the individual investments, what they do, selling and buying and all that of the individual stocks. You just hold the ETF and you ride along with that. Pro tip with this account: if eligible, start that Roth IRA as early as possible in your career, because typically with a lot of career paths, you start off at a lower income amount. And then you get into the higher income as you go on, maybe promotions, maybe you go to a different company, you get more money, your salary increases. And then by the time you retire, you're making more money than you were when you started off. And in that case, that money that's been growing all those years and decades that you've been working can be withdrawn tax-free if you had a Roth IRA. So that lower tax bracket that you're in, starting off and throughout their career that you're contributing, not that big of a deal. You don't have to worry about trying to lower it with the retirement account. You're just like working through it, everything. And then by the time you retire, you're in a higher tax bracket. So if you withdraw from money from a account that you're going to get hit with taxes in, that higher tax bracket, that means you're going to get hit with higher taxes. But if you have a Roth IRA, no matter if you're in that higher tax bracket, you can still get that money withdrawn with no taxes on it. Now, of course, there are limits and things going on with how much you can contribute to the IRA. And then if you make over a certain amount of money, you won't be eligible to open a Roth IRA. However, there's backdoor Roth IRAs out there, different things. So look into that if you're more interested in that. I don't want this video to go on too long, but yeah, there are ways to have an individual retirement account. Let's go on to the next account, and that's going to be the taxable brokerage individual investing account. What is this? This is a regular investment account without contribution limits or tax advantages. You pay taxes on dividends and capital gains. So this is separate than an individual retirement account. There's no withdrawing from this and not getting hit with taxes and so forth. However, there's no penalty with this as far as you want to sell, your securities, your investment in this and withdraw the money and transfer it over to your checking account or savings account. You can do that and not get any kind of penalty for any kind of early withdrawal. However, there are taxes involved. There's short-term capital gains and long-term capital gains. If you make a gain on a stock, ETF or something in this account and sell it within 1 year, you're going to get hit with short-term capital gains. If longer than a year, long-term capital gains. Long-term capital gains are going to be lower than short-term capital gains. There's also short-term losses, long-term losses, which can offset each other. So this is going to be something that will go on your taxes each year. Taxable brokerage account, individual investment account. Why does it matter though? It offers maximum flexibility. You can invest in stocks, ETFs, bonds, and withdraw funds anytime without penalties. This is great for random or structured investing and once you've maxed out retirement accounts. So what I mean by random or structured investing, let's say you're watching the market took a big hit, but it's kind of temporary, something's going on. There's great companies out there trading at a discount, great ETFs trading at a discount. You're like, oh man, this is a great time to buy. You don't have to wait on a contribution to hit your account or so forth like that. You can transfer money from your checking or high yield savings account if you need to over to this account and buy that stock, buy those stocks, buy those ETFs, whatever, random, just going along with the market. or structured, dollar cost averaging, every week, every month. However, you want to invest a certain amount of money in certain stocks or ETFs or both or bonds or so forth. You can do that structured. You can set that up to have that going. This account you have a lot of control over with how you invest, when you withdraw, how you withdraw, and so forth. And what I mean by once you've maxed out your retirement accounts, individual retirement accounts, IRAs have limits. You can't put a ton of money in there. It changes, it fluctuates, 7,000 or 8,000. Of course, that limit has changed. It's increased in the past. And once you hit those limits for those IRAs, that doesn't mean you have to stop investing in the stock market. You can continue investing with this type of account right here that doesn't have a limit. This is a great tool for financial success and financial freedom. Now, examples of this account, some companies that offer individual investment accounts include Fidelity, Charles Schwab, Robinhood, SoFi, Interactive Brokers, and there's several more out there as well. This is an account for sure that I want to make sure I have access to buying fractional shares in. And I went over that in the IRA section of the video. If you somehow skipped it or missed that, definitely go back into that. Gets more into fractional shares. I think that's a very important thing that could benefit a lot of people. Me personally, I like to do that. I like to put, $100, $200, $300 in my individual investment account and put, 100 in Microsoft, 50 in SoFi, 50 in NextEra Energy, 50 in NRG, 50 in TSM, 50 and so forth. You get the idea. So I like to kind of spread it out, and especially if, you have certain stocks that, are kind of trading at a discount, or maybe you're just dollar cost averaging each month, each few weeks you're doing this. That way you can have access to buying bits and pieces of shares, and it adds up. By the time you look at it, I've got 15 shares of Apple now. I've got 25 shares of Alphabet now, and so forth. You get the idea. By those fractional shares add up. And if a company pays a dividend, you still get paid a dividend for those fractional shares. You got 17.5 shares of Target, where you're getting paid dividends worth of 17.5 shares of Target. You get the idea. All of those companies right there listed in the examples do have that functionality, but you want to look for other, of course, features. Now, key benefits for this account is unlimited contributions, no withdrawal restrictions, total control. We went over that, but that's just a summary of it. Now, this account is great for wealth building outside of retirement accounts. Now, a lot of people don't have this account going on. They got their checking, their savings, their, employee sponsored plan, and maybe that's it. Or maybe they have an IRA and that's it. And you can definitely have great financial success with those accounts and financial freedom, and even have FIRE movement. I mean, you're going to get hit with a penalty if you retire earlier than, a certain age and so forth. But this taxable brokerage account is a way to definitely hit that financial freedom early and have that FIRE movement going on, because you can set up this account maybe for high growth at first and then kind of go into dividends more, or have a mix of it throughout and live off the dividends off the account. Or maybe sell out of a big chunk of the account and live off of that, put that in another interest bearing account, or so forth. You get the idea. This account, you don't have to wait to a certain age to take profits. So that's very important with this account. Now, a pro tip with this account is holding the investments long-term to benefit from lower long-term capital gains tax rates. If you've got a big gain on a stock, you want to take some profits off, you may want to look at when you bought that stock compared to when you're going to sell it. Maybe if you got another week left until it's been over a year, maybe you want to wait. And then you'll have that lower tax amount. Maybe you can't wait. Just know that you're going to have short-term capital gains tax instead of long-term. And short-term capital gains tax rates are higher than long-term capital gains tax rates. So just keep that in mind. Holding investments long-term, you're going to have less taxes when you sell that stock, that ETF or so forth, and take profits. Now, let's move on to the bonus account of this video, and that's going to be the HSA, the Health Savings Account. An HSA is a savings account for medical expenses with tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified healthcare expenses. If you're eligible to have an HSA, this account can be used as a retirement stealth account, since the funds roll over year and can be invested. Very different than an FSA. You may be thinking, oh, that's like a flexible savings account. No. Flexible savings account, FSA, you use it or lose it by the end of the year. So, have people out there rushing, they're buying things by the end of the year so they don't lose that money in the account. And HSA, the money in this account, rolls over to the next year. Examples of this account, some of the companies that offer this one: Fidelity, Lively, HSA Bank, Health Equity, and so forth. Now, key benefits of this account: you got triple tax savings. It's portable. You own this account. And also another key benefit with this account is that it can be used for healthcare or retirement. Now, after 65, non-medical withdrawals are taxed like a traditional IRA. Pro tip with this account: if you can, pay current medical bills out of pocket. and invest the HSA funds. So it's kind of like a hack with this account. The account itself is kind of like a stealth retirement account. And then you can kind of have a hack going on with it. You don't have to use this account when you have medical expenses. Maybe it's just a small medical expense. You're just like, I got that money invested going on. I got funds I can invest in the HSA. I'll just pay this out of pocket. And of course, you can use this account for medical expenses for sure. But that's just kind of like a tip. You may find that useful. You may think I'm really going to try to use this HSA as kind of like a side retirement account. That could be a pro tip for you with this account if you have one of them or you're thinking about having one of them. So those are 5 accounts that could form the backbone of financial freedom for you, plus one powerful bonus if you qualify. The key is using each one for its specific role. Checking for daily cash, savings for protection and growth, retirement accounts for long-term wealth, and brokerage for unlimited growth. If you found this video helpful, be sure to hit the like button down below and subscribe to the channel for more money strategies and financial education. Hope you all enjoyed the video. Thanks for watching. Take care.